In 2025, data centers consumed around 23% of Ireland's power.
Whoa.
Yeah, nearly as much as all households combined.
What?
Yeah.
The reason that there's a backlash is because putting one in the middle of a small community is just going to drive power prices up. Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name's Bryce.
And I'm Ren, and today we've got a big episode. We're talking about the backlash to data centers, rising borrowing costs, notable results from earnings seasons, and Pimp My Portfolio is back. We've got Vishal joining us in the studio and Owen Rask having a look at his portfolio. Bryce, big episode today.
Big episode. I think Pimp My Portfolio is front of mind. There was a post overnight in the Facebook discussion group demanding its return.
And we are nothing if not subject to your demands.
Exactly.
So here it is.
Here it is.
If you're not part of the Facebook discussion group and you want to demand things of us, head to, we'll just search Equity Mates discussion group on Facebook.
Yeah.
I was going to give the URL. You could go to, go to facebook.com/groups/Equity Mates if you want. But yeah, it's some great conversations going on there. Join 30,000 odd investors sharing ideas, answering each other's questions and demanding things of us.
Yeah.
But Bryce, that's not actually the announcement we were going to start the episode with. FinFest is officially just 10 weeks away.
I know. Scary when you think about what we need to get through to get to that point, but it is shaping up to be an absolute cracker of an event. I did tease last week that the lineup is something that we are incredibly excited about. Global level lineup. So we thought we'd just go through some of the guests that are locked in, some of the sessions that you can expect on the day.
I can't help but laugh because the sessions that we're going to talk about today are all Australian speakers, but we are cooking some things up in the background.
Exactly. That only means one thing, there's more to come.
But look, that's not to talk down the epic lineup we've got. The purpose of FinFest is to take the best parts of investing conferences and events that happen often during the week, often at times that aren't accessible for people like us, people who work 9 to 5s, or who are at price points that are just ridiculous.
Yeah.
Take the best parts of that and put it on at a time and at a price that everyone can attend. And God, we've got some good sessions lined up.
Yeah, we've got Joe Aston, former AFR columnist. He now runs Rampart, and he makes corporate Australia wobble at the knees in fear.
Yeah.
So we're going to sit down with him and interview him on main stage, which we're excited about. We've got Scott Phillips from The Motley Fool. He's going to be doing a session on a one-page investing plan. Deanna Messina, AMP economist, she's been on the show, very popular. She's going to be helping us understand what is going on with the Australian economy and where to next for property. And then Adam Dawes as well. Last session of the day, it was the most popular session of 2022. The buy or sell session where you just get to throw stocks at him on stage and he'll give you a buy or sell.
Yeah, speaking of interactive sessions, we've also got Dr. David Allen from Plato. He is going to be bringing his red flag system.
Yeah.
We've interviewed him before. You should go and check it out. Fascinating interview. He'll be doing an interactive session where you can throw companies at him and he will tell you if there's red flags to be worried about. He's also going to talk about how we can just generally identify companies before they blow up.
Yeah.
We've got Effie Zahos. She's going to be speaking about building a portfolio at different stages of life. We've got Junbei Liu talking about finding growth stocks in Australia. We've got Luke Larrative talking about Australian mining and how he finds great opportunities there. And that is just the first cut of the sessions that we've got. We've got a full day programmed across 5 stages. It's going to be epic. Whatever you're interested, there's going to be something there for you.
And you mentioned at the start, Ren, that it's all about being accessible and affordable. So tickets are only $55. You're going to get so much value there on the day. Tickets are now live. Grab yours soon.
equitymates.com/FinFest. See you there.
News and markets.
2 stories that we're going to be covering today. There's backlash growing over data centers and the borrowing costs keep rising. So Ren, let's start with the backlash that is growing over data centers. And the headline that we're going to use to kick it off is around the requirement here in New South Wales, or the optional requirement, I guess, for data centers to source 40% of their power from wind.
So if a data center planning proposal includes wind power, it will get fast-tracked planning approval. I think the government will assess it within 75 days. So it's a way to jump to the front of the queue. This is partly to deal with the backlash over data centers. People are not in love with data centers, and we've got some global stats to back that up in a second. But it's also to revive our struggling wind industry here in New South Wales.
Yeah, I don't mind it. It's a good one. But the scale of the, I guess, energy challenge is pretty significant. The government is projecting data centers could account for up to 11% of New South Wales energy needs by 2030. So if you think about the pressure that that's going to put on our energy grid, using this as an opportunity to revive wind farm projects is a pretty good idea.
Yeah, now this is part of a global backlash to data centers, and this is part of a bigger story that we wanted to talk about. Look, I don't mind it. You know, there's a tsunami of money coming to build data centers. I like the thinking of what can we get out of it and what can we make them pay for that will last a lot longer if this AI theme is a bubble. And building out our renewable energy infrastructure seems to be a good one.
Yeah.
Maybe they can, rebuild crumbling infrastructure, make Microsoft build a few bridges if they want to build a data center as well. But look, there's a global backlash to data centers. I think that's fair to say. We've got some numbers out of the US that just paint the picture. So let's start here. A Gallup poll found that 71% of Americans oppose having a data center built in their local community. That is higher than the percentage of people that oppose a nuclear power plant being built in their community. So, question without notice, what would you rather, a data center or a nuclear power plant in your backyard?
Oh, geez. Nuclear power plant.
Okay. And the opponents to data centers are having some success. So there's a watch group in the US that track community opposition to data centers and how many have been blocked. In the first quarter of 2026 alone, 75 projects were blocked or delayed, representing $130 billion of investment. That was more than double the $64 billion that was blocked between 2023 and 2025.
Wow.
So obviously there's more projects trying to get up, but opposition is growing. A big reason why is electricity consumption.
Yes.
Water consumption is also a concern, but the industry have found solutions to that in some ways. Like there's a lot of closed loop water systems now, but power is the one that is a huge concern. In the US, data centers use 6% of electricity, the UK 5.8%, Germany 9.5%. In the New South Wales article, it's predicted to get up to 11%. It's not 11% now. That's 11% by, when was it? 2030, they expect. But how is this? And I had to double check it because it didn't seem right, but it is true. In 2025, data centers consumed around 23% of Ireland's power.
Whoa.
Yeah, Ireland's electricity. Nearly as much as all households combined.
What?
Yeah.
So really what you're saying is the reason that these communities there's a backlash is because the power grids are so localized over in the US that putting one in the middle of a small community is just going to drive power prices up.
Doesn't matter how localized it is. If these things suck up a huge amount of power, utility rates are already going up. Demand goes in. Yeah, utility rates go up further.
Yeah.
And there's also a lot of backlash because a lot of these companies operate in quite, not nefarious ways, but they extract the best deal possible they can from the community. So, they'll often negotiate like no sales tax or like no state and local taxes, which then local communities often are off. And they also make local governments sign NDAs. So they can't talk between governments about how they're negotiating and like share tactics, also can't talk to their local community. There is a better way to do this. And like the New South Wales government's approach is definitely a better way than what we're seeing in America, which is if you want to build a data center, we're going to take our pound of flesh.
Yeah.
Yeah.
Well, staying in America, New York, they've taken a bit of a harder line. They now have a 1-year moratorium. So what that means is there's a pause now on any new hyperscaler data centers being built, brought in by Governor Kathy Hochul. Kathy Hochul. And that is for facilities using more than 50 megawatts of electricity. So they've put, a limit on the scale that they're willing to approve.
Yeah, and New York aren't alone. I think there's about up to 15 states that are either considering or in the process of passing data center moratoriums. So the backlash is here. And it's an interesting question. What happens when an immovable force meets what's the question? Immovable force meets an unstoppable object or whatever.
Yeah.
It's like this tidal wave of money that's coming from tech. What happens when it brushes up against like government bans and where does it go? Because Goldman think 920 billion will be spent next year. Morgan Stanley think it'll be 1.1 or 1.2 trillion will be spent on data centers. That money's got to go somewhere.
Yeah. All right, so moving to the borrowing costs, we're seeing a worrying trend, I think, in terms of long-term borrowing costs rising, not only in the US, but in Japan, Australia, and Canada. But we'll start with the US because the 30-year Treasury yield rose to around 5.31%. That is the highest level since 2007. It's getting markets worried.
Yes. Well, anything that is related back to 2007 or 2008 instantly is a concern. Japan, the 10-year government bond reached 2.93%, its highest level since 1996. Yields have been climbing in, as you said, Australia, Canada, Europe. The Australian 10-year is above 5%. It peaked at 5.16% in March 2026, which was its highest since 2011. It's a bit off that, but it's still obviously above 5%. It's high. This has people, I guess, a little bit concerned because of what it says around inflation.
Something certainly to watch because these rates, the borrowing rates for governments affect everything. Asset prices, mortgage rates are going up. So it does have a big flow-on effect across the economy.
Government debts are structural. Governments are going to have to borrow more to pay those debts. I think the US servicing costs on its debt just flipped military spending.
Yeah,
in terms
over
of
$1 trillion, isn't it?
Yeah, in terms of how much they're spending now, not just on not on paying down principal, just paying interest on their debt.
Yeah.
And this is going to be an ongoing challenge for governments around the world as investors demand more to continue funding their debts. But it's also a sign that the market thinks inflation is stickier than a lot of politicians are willing to admit.
Yeah.
And I think as investors, we should prepare our portfolios accordingly for inflation being higher for longer. Thinking about inflation protection. If you're a bond investor, you maybe want to think about like tips like in inflation protected bonds. If you're a stock investor, thinking about companies with pricing power, thinking about infrastructure. It's not catastrophic. We've been living with inflation above target for now, 5 years? But the bond market certainly thinks it's not going anywhere.
Yeah, definitely one to watch. Make sure you subscribe to our daily newsletter or our daily podcast where we'll give you a dot point summary of the most important news headlines from around the world. We'll also keep you updated with news on FinFest and some of the key insights that we're pulling out from all of the discussions we're having with experts on the show. You can click the link in the show notes or the description below. Coming up, we are looking at some of the notable earnings that have come out of the Australian reporting season. We're getting towards the end of Australian reporting season, that period of time where listed companies let us know how they are performing. And we've got 3 companies here that we want to touch on that we thought had interesting results. Last week, we spoke about some of the bigger companies, CBA, REA Group, car sales, all with varying degrees of, success. But we've got 3 companies today, Ren, starting with A2 Milk.
Yeah, well, we said early in reporting season, companies that have good news like to jump to the front of the queue and share their news. But the back end of reporting season, you start to see some results that are not so good.
Yes.
And unsurprisingly, most of the companies we're talking about today, not so good. And then one absolute star that we're going to end with. But let's start with a company that's close to my heart.
Yeah.
One of my first investments, one of my best investments, no longer hold it though, to be clear, but it's A2 Milk. It lost almost 2/3 of its Chinese customers after supply shortages. The stock, when it reported, dropped like 9% on the news. It recovered a fair bit after that. But the actual business story underlying it was they left distributors short of stock, particularly going into China. Chinese label infant formula revenue dropped 33% in the second half because of it. And a lot of Chinese customers switched to other brands, so it's going to be harder to get them back. Net profit fell 6% as well.
This is a company that's just so tied to the China story.
So tied.
Still.
Yeah.
Like that was the thesis when you invested in it almost 10 years ago.
Yeah.
And I remember there were many instances throughout the last decade where China's demand has dropped, or these, A2 milk hasn't been able to service the demand.
The Daigou channel gets shut down. Yeah.
It's just like, if you're investing in this company, you need to be so across the China story.
Yes. Yeah. I was working at Coles at the time in stores, and I always said my sell signal is when we could keep infant formula on the shelves. We were limiting it to like 2 per customer. We had it behind the service desk. At some stores, they would just drop a pallet and they wouldn't even unstack it because it would just go. Yeah. The demand isn't that hot, but demand for A2's infant formula in China is still incredibly high. The challenge for them has always been getting it to China and selling it there. But to be blunt, like, I'm not investing in A2 milk for anything outside of the infant formula story. Like, you go to the supermarket and their 1 liter of milk is about 3 times the price of anyone else's milk. Like, it's infant formula in China or bust for this company. And so it's a shame that this happened.
Yeah.
And that's just my personal opinion.
Yeah, of course. Yeah. All right, moving to JB Hi-Fi. Shares fell 14% as there was mixed expectations off the back of its earning. They posted a 6% lift in full-year profit to $489 million. That did fall slightly short of expectations, though, and when you fall short of expectations, your share price often falls as well. Analysts were concerned around near-term sales recovery. It's all linked to the housing, obviously, here in Australia. As house prices decelerate, consumer confidence is starting to decelerate as well, and their ability to, well, not their ability, but their willingness to spend is dropping.
Yeah. I think it's 2 things. One, it's that wealth effect of people feel like they don't have as much money if their most valuable asset falls, so they tighten their belt. It's also, as people change houses, they then go and buy like a new coffee machine and a new TV and all of that stuff. And so that will also be a headwind for them. But for me, JB Hi-Fi is one of those companies, the amount of times people have doubted them.
I know.
And I don't own it. I've actually never owned it. But forget expectations. Just like strip everything away. It's a company that put up another 6% growth in net profit in a challenging year. And its New Zealand business grew even more, grew 26%. But I don't know, it's just one of those companies that I never believe in enough to buy, but it keeps doing the thing.
Yeah. Every report.
Yeah. It has seen some big transitions in its life as well. I remember back in the day it was selling CDs and DVDs.
Yeah, records.
Now it's tied to housing turnover because it's like completely changed what it's selling.
Yeah.
But it just keeps growing.
Keeps ticking away.
Full credit to the JB's management.
Yes. And finally, I just wanted to check in on CSL. It was in my portfolio. As you know, I've sold. It's reported this morning at the time of recording. 2% fall in annual profit. It is really driven by declining revenue in its core plasma division, the core of its business, really, CSL Bearing. It's really facing a temporary slowdown due to a reduction in its US inventory, so the US business. So still facing headwinds. The stock had been on a bit of a run since its bottom about a month ago, up about sort of 40% or so. But yeah, for what was a market darling, it's certainly still facing plenty of headwinds.
Yeah, it's funny. It's like for a 2% fall in annual profit from August last year to its bottom earlier this year, it was down almost 2/3.
Yeah, smashed.
For a 2% fall in annual profit.
I know.
We shared some charts recently that showed some of the big tech companies which had growth stall and how much the share price was punished. And the one that always stands out for me is Netflix. It went from 222 million subscribers to 221 million subscribers in 2022, partly because it pulled out of Russia and lost all of its Russian subscribers. The share price dropped 77%.
Yeah, I remember that. Yeah. Crazy.
Just like these little hiccups. And then Netflix returned to growth trajectory. It's, surpassed where it was before. This CSL could be a similar story.
Well, I'm starting to see it appear more and more on managers' watch lists or buys. So I think, as we spoke about when I did sell it, like, it was either an absolute value play or a value trap. But I think it just got to a point where it was so true.
That's the insightful analysis you can expect at equity, mate. It's either going to go up or it's going to go down.
But it got, what did it get down to? $96 after trading at 300.
Yeah. So there are 3 companies that kind of disappointed investors.
Yes.
Here's a company that isn't disappointing investors. It's not officially part of reporting season because it's not listed, but it did share its quarterly numbers and they got leaked to the press. Anthropic, the AI company behind Claude, reported quarterly revenue. It was up 20 times year on year. So in the second quarter last year, it made $787 million in revenue. The second quarter this year, it made $16.2 billion in revenue.
If they keep doing numbers like this, whenever these guys go to list or OpenAI, it's going to be an absolute frenzy.
Yeah. So Anthropic has overtaken OpenAI. It overtook them earlier this year on revenue run rate. It also went from the first 3 months of 2026, it did $4.7 billion to $16.2 billion. So it grew like 4x quarter on quarter.
Yeah.
Like these growth rates are astounding.
Yeah. It is astounding.
The question is, can they be sustainably profitable? But you're not going to find faster growth.
No, that is incredible. Well, we'll leave it there. Plenty of companies to keep an eye on. Make sure you're tuned in across our network as we bring more information about the Australian companies as we close out reporting season in the next week. We're going to take a quick break, and on the other side, Pimp My Portfolio is back with Owen Rask and a community member, and this one was an absolute cracker. We'll be right back.
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get our community members to submit their portfolios for one of our experts to review, to hopefully provide some ideas on how they can improve it. In the studio today, we have our expert, Owen Rask. Owen, welcome.
Gents, it's good to be here. Really good to be here.
And our community member today is Vishal. Vishal, welcome.
Thank you for having me.
Vishal, before we get into the nitty-gritty, can you just introduce yourself and then run through your portfolio?
Sure. So I've been living in Sydney for like last 20 years. Came here in 2004 for studying. Did a semiconductor manufacturing course in RMIT in Melbourne. And it was like, kind of unfulfilled dream where I wanted to work for a semiconductor company. I did land one job here in Australia in Olympic Park, the only semiconductor manufacturing company which is no longer there anymore. So I pursued a career as a data center engineer, so building data centers, and started buying shares because I was working for a company which General Electric, and they had the employee share schemes, and they were offering employee shares with like a 10% discount or something. So that was my first pretty much entry to the share market.
Awesome.
Wow.
Awesome.
This is really
right
cool.
in the thick of it.
Yeah.
So do you want to just run through some of the key components to your portfolio?
Yeah, sure. So as you can see, my biggest holding at the moment is Southern Cross Engineering. There are not that many ETFs because I believe in buying individual companies, businesses which I can hold pretty much for the next 10, 20 years. And ETFs for the last 5 to 10 years, especially after COVID, seems to be a bit crowded. Even after watching every single video of this episode, people have, everyone just talks about ETFs. So I felt like that it was getting overcrowded, or everyone is just buying ETFs. So I thought there is an opportunity to buy individual businesses, and that's where it started. So Southern Cross Engineering, it's funny that because I was working in data center building industry, there were a couple of my colleagues which were working in Western Australia. They had a small company and they were taken over by Southern Cross Engineering. So I started looking into it, and that's where I started buying shares.
Nice.
Wow. Now, before we get into a conversation around Southern Cross Electrical, just to give people a sense of the portfolio, there's 41 stocks in the portfolio. So we'll unpack that. And then there's 3 ETFs. But as you said, they're small holdings. NASDAQ 100, iShares Semiconductor, and the S&P 500.
Yeah.
And maybe I'll just say the top 5 stocks. So Southern Cross Electrical is about 20% of the portfolio.
Yes.
Alphabet is 8%. Catalyst Pharmaceuticals is about 8% as well. Scorpio Tankers is just shy of 8%, and then Chubb Limited is about 6.5%.
Yes.
So Owen might want to talk about some specific names, but that, I guess, is a overview of the portfolio. With that said, maybe let's start with Southern Cross Electrical.
Sure.
I just want to give a bit of a theme to this episode, and the theme might be how many is too many.
Yes.
And this is an important nuance with Vishal's portfolio here for everyone. We say he has over 40 stocks, but if you took the 32 smallest positions in terms of percentage, that only adds up to 20%. So these are like small That's like smaller than his single biggest position.
They're like a keep me interested research position.
Yeah, I would think of them.
Is that
That's kind of my watch list. So what I do is I make a position of $1,000, $2,000, and I keep. So that allows me to follow that company quite seriously because I have put my money into it, and then I keep adding the positions. Pretty much like Southern Cross. I have bought Southern Cross for like 20 times in the history.
Yeah.
So I follow every single quarter, and I can only do that when I put my money into it. I can't do it only sitting there without investing in it. Once you are in, you start taking it seriously, and that's why I buy it, no matter even if it is $1,000 position. I just started.
That's great.
That I take seriously.
Nice.
It's. I think the thing that really fascinates me, and the thing that I wanted to understand a bit more, and you kind of shared it with us already, is just how do these companies end up in your portfolio? Because yes, Southern Cross is 20%, but you told us off air it didn't start as 20%, and you really let your winners run, right? So we get this like snapshot of, holy heck, Vishal's got 20% in this one stock. That's not diversified, right? That's like the first thing you think. But this is why we invest in individual businesses, isn't it? To find great businesses and let them grow.
Yep.
So I'm vaguely familiar with this company. I'm more familiar with a company called Mass Group, which is MGH on the
That's
the
on
ASX.
my watch list.
Yeah, there you go. Need to put $1,000 into it, maybe. But that's another business which is similar in where it's going, and Southern Cross is all about, at the moment, the narrative is all about data centers.
Yes.
Australia can't get enough electricians. The electricians know what I'm talking about. They're increasing their hourly wages crazily, and they're all going to data centers, right? You guys had David Pocock on the show who talked about like the suction effect that's going to happen with data centers and electricians. Southern Cross is the probably pole position to benefit from that.
Yes.
And so if everyone's out there looking for like an Australian way to see what's happening in this local data center space, Southern Cross Engineering, top of the list. Mass Group would also be up there. Bit of a different business, but up there. So I just generally don't have like a huge problem with that.
Yeah.
I don't know if you guys have a different view, but I just generally don't have a problem with that.
Well, Vishal, Owen's kind of given a thesis for the stock, but what I will ask with Southern Cross is it's up 125% in the past year.
Yes.
Are you tempted to take some profit off the table?
Not really. So there was one incident happened with Southern Cross where they announced they lost a lawsuit they had like a $50 million fine or something, and I was really panicking that morning that they're going to make this announcement and the share is going to drop 20% or something like that. It was pretty crazy because that was the first quarter they had negative earnings, first ever in the last 5-10 years. And the market did not move. They accepted that honesty from the management, and that is shown in every single quarter. The management has been very honest with every announcement they make, and that's why I really liked about that company, and I made up my mind that I'm never gonna sell as long as the valuation is still there. Even now, every day, there are fund managers giving the valuation on that, and it's still around $5.50. So as long as that doesn't become ridiculous, Nvidia and something like that, and again, even tomorrow AI industry goes bust for whatever reason, AI is only 10-20%, or the data center business for them is not the whole entire business. It's only 10-20%, so it's not affected by that.
It's really interesting. So this business is an industrials business. So really interesting in that as its revenue's gone up, its margins haven't increased. So as in the revenue's gone straight up and the billable work's going straight up, but the margins don't increase, and that is just a really telltale sign that this is just a industrial service-based business that works on projects with tenders. That's what you see in all these businesses. The thing that I always think about, Vishal, is when comes the point where people no longer are baking in these long-term growth expectations. Typically what I've seen in the past is it's not necessarily the point at which the growth starts to slow or the new tenders start to slow. It actually happens before that. So before management disclose, hey, we haven't grown our tender book as fast, or our billable work is not as growing as quickly. The sell-off or the pressure that is felt in the stock typically happens before that, because investors, like with this lawsuit, are looking forward. So most investors, when the share price doesn't fall on the day, what it tells you is that the market has already factored that in.
Okay.
So typically you've got to be one step ahead, and you've got to think, I'm not just forecasting for the next 12 months or the next 2 years. I'm going to forecast what other people are forecasting in 1 or 2 years.
Okay.
Because if you think about it, you don't want to be the seller to the buyer that's like marginal in 12 months. So you want to be the seller to the fund manager that talks about it in an online publication. When that happens is when you're going to get peak valuations.
Okay.
So it's not to say that it's like be there for a good time, not a long time type of business, because we think that data centers, AI, electrical engineering, all these types of industries are in boom time and most likely are going to continue for 5 to 10 years. But that said, there will come a time where demand and supply come more into an equilibrium.
Sure.
At that point is when you test your thesis and you go, do I still need this in my portfolio?
Yep.
Now, we should mention the other companies in the portfolio. You've got a lot of really, I would say, just really good businesses further down the list, like Berkshire Hathaway's in there.
Yeah.
So that was one of the first ones, and that was a no-brainer because, again, you can't go wrong with Berkshire Hathaway, I guess. And again, I do, I never have bought any company which was not down by 10 to 15%, never bought it at the peak. So that always gave me some buffer, especially quality business like that, if for whatever reason, if it was down by 10 to 20%, I just go in.
Yeah.
So I understand, or we understand the process you go to get the companies on the list here. It's sort of like a live watch list where you're putting $1,000 on. But surely when you're then reviewing these stocks, not all of them should deserve to stay in there. What is your sell process, if at all?
Again, I haven't got any experience in selling. So that is,
You've never sold.
It's because of not really. So because of the tax reason is one of the things, and I need to definitely learn that part of it. But I have been again, even though there have been a couple of stocks which have been 90% down, and it did not bother me because the winners have taken care of it. And I think the discipline of not selling have, I have survived because that. For example, General Electric, I was there for 2 years. I was putting $1,000 a month, $20,000 I put in. And then the shares collapsed to $5,000 or something at some point.
Wow.
I didn't sell. The CEO, Jeff Immelt, at that time resigned because of all the purchases he made, acquisitions he did, and then the new CEO came in, and it has gone 10x since then. Yeah.
What are your thoughts on the no sell philosophy, particularly when tax is used as a reason not to sell?
I think that, if tax is the reason, tax losses are pretty handy. So if you've got some losses, you may be able to take them, and that may help you in your tax return. But I actually don't hate that idea. I think this portfolio reminds me most of a David Gardner portfolio from the Motley Fool, if you're familiar, which is buy greatness, add to greatness. That's his very simple philosophy, find great companies and just keep adding to them. And if you decide to sell when you're retired, you decide to sell when you're retired.
Yeah.
And that is a very, very well-worn path. And if you follow the rule breaker philosophy in the US, it's done really well. It's not really well executed in Australia because we don't have those types of greatness style companies. No offense to Australia.
I would challenge you on that.
We do have the Pro Medicuses of the world. Even Southern Cross.
BHP has been a great growth company for 70 years.
Definitely. So it's nuanced, but in comparison to what we've seen in the US, it hasn't been for every one Pro Medicus we have here, there might be 10 over there.
Yeah.
And that's been the big difference. But in terms of not selling, I just think that the biggest risk actually from a portfolio, and this is for anyone that has kids or a partner or anyone that's not as interested in money, is you've got to think about this is your passion and hobby by the looks of it. It's something that you love. Yeah. You need to know why you're investing. You've got to tie it back to that. You've got to tie your strategy back to that goal. And I know we're not talking about goal setting here today, but should there be anything that changes in your interest, should there be anything changes with you being able to manage this portfolio, what happens then? And that's one of the byproducts of a really sensible core portfolio, like a low-cost ETF portfolio, is that whoever comes next can pick it up and run with it. So make sure when you do this that you're writing down your thesis, you keep notes, you articulate your strategy, and maybe you chat to your partner or whoever your significant other is in your life and tell them why you're doing this and why you hold these positions, because I do see this later in life. People do really well, and then ultimately they come unstuck because it's just them. They lose interest. They just, like myself, like I used to love buying stocks. I used to have a portfolio that had 30 stocks in it. I don't have that anymore. It's not that I'm not that interested. I just not as interested. And I also know that if something was to happen to me, my partner would have to deal with that. So, and she doesn't want all these rando stocks that I've got from across the world. But that would be one of the big things that I'd just be mindful of as you go on this journey for the next 10 to 20 years.
Yep.
And tightening up, if you wanted to, tighten up the portfolio. But I just think if most people approached it, that 20 punch card philosophy from Buffett, which is you got a punch card with 20 holes. Yep. You can't do more than that.
That's right.
What are you going to do?
Yep.
Well, you don't sell.
Vishal's blown through that.
Well, he's got
two punch cards.
But I do like, there is another one, which is, would you buy this if you could never sell it?
Yeah.
That is
That's
a good,
right.
yeah.
Yeah. And I talked to my
disappointing.
9-year-old, compared to my wife, she doesn't want to know anything about this.
Okay.
But my 9-year-old, he's always interested, and it's a good practice for me to tell him what I what I have got. Even last night I was going through, this is the one I bought this, and the bad ones are only because of so I use this website called TradingView, and the way journey started was I was looking at the performances since inceptions. What are the stocks out there since the inception? What was their performance like? And you have all these Googles and the Microsofts of the world, 10,000, 20,000% returns since inception. And there is a page called statistics, and where it gives you all the ratios and the statistics per share. And if you put them side by side, they pretty much more or less look the same, return on investment capital, 30-40%. And that's exactly the image I got in my head. Okay, the high performer looks like this. And I was literally putting that image and looking for those pictures in the Australian companies or any company, doesn't matter, is a micro cap, a small cap, or a mid cap. And as soon as I started doing that, doesn't matter which one you buy, it just literally performs the same way. As long as those ratios are matching to the companies which have been performing to that level. So Southern Cross was Catalyst Pharmaceuticals was like that, and it was actually ridiculously cheap. It was PE ratio 10. It was my 5x, 7x. It was, I think it's been delisted now. It's been taken over. But that was one of my, really one of the successful stories out there. Scorpio Tanker is one of those as well. I bought it because Michael Burry bought it.
Okay. He doesn't always
one positive thing.
But he sold it within few weeks. But I said, no, I'm going to stick with it. No, there is no reason for me to sell it. And that's the story. Every single stock here, for me, it has to be bought by one of the fund managers or one of the billionaires or super investors. So if I find something, get an assurity by Luke Larity, I think people like him. Yeah. If someone is that gives me an extra conviction that I gotta buy this one.
Yeah.
Vishal, we have run out of time, and I think it's a very impressive portfolio. And I think the lesson is you need to do the work to be a good investor, and it sounds like you're doing the work.
Thank you very much.
Of the 41 stocks here, just leave us with what's one that we should go and do the work on.
This guy.
What's a name? There's a lot of names that people aren't as familiar.
Does it have to be from here? Because I made a list from some of the other ones, or does it need to be from here?
No, give it from your portfolio.
Okay.
Yeah.
From the Australian market?
No, whatever. Just what's one that you love in there that you think we should check out?
You really made me nervous. I think Scorpio Tankers.
Scorpio Tankers. Okay.
Definitely, I love it. And again, all of these it hasn't happened one hit.
Yeah.
I always love to own something which I can buy at any given point, especially when they go 10-20%, with the fuel prices and all that. Scorpio, again, the management, it just is so good, in terms of how they've been reducing the debt and things like that. It's pretty good, and it's been always on single-digit PE with a really good dividends. And people when Michael Burry, when they buy it, the valuation is so cheap. You got to get in. I mean, I don't agree with all purchases he's done in the past. I got some of the holdings here which he's been shorting, which kills me, Micron and all that. And again, with the Micron, people talk about Micron when the valuation becomes so extreme, but they don't never talk about when the valuation was extremely cheap. When people like Michael Burry and Monish Pabra and all those guys were buying in Micron, nobody talked about it because it was so cheap and nobody even looked at Micron at that time. And I had like $2,000 sitting there from the dividends. I just put that in Micron and it's almost 15x now.
Wow.
Love it.
Well, that's
That's great, mate.
That's the money from the
Vishal.
dividend.
Yeah.
So that's Scorpio Tankers, STNG is the ticker
I
symbol.
love the business because of the management. Again, not like, Warren Buffett, like, they never recommend to go into transportations or airlines and things like that. But there is always like, these are the rules which are made to be broken anyway. Like, you can always find somewhere a company within that industry. And I only bought it because of Michael Burry. So thanks to him.
Love it. Well, we'll leave it there, Vishal. Thank you so
Thank you
much
very
for
much.
submitting your portfolio. We really do appreciate it. I'm sure a lot of people listening took a lot out of that. So
I'm
thanks
a
so
big
much.
fan.
Thank you.
I always been looking forward to it and it happened. Unbelievable.
Thank you, Vishal. Yeah, no, we
Thanks, Vishal.
appreciate it.
And Owen, as always, thank you so much.
Thanks, guys.
This podcast is intended for education and entertainment purposes only. Any advice is general advice and has not taken into account your personal financial circumstances. Before acting on general advice, you should consider if it is relevant to your needs. If unsure, speak to a financial professional. The host of this podcast and their guests may have positions in the companies mentioned. Equity Makes Media is part of the BetaShares Group but maintains editorial independence. We operate under Australian Financial Services Licence 540697.